Even though these first 7 months in the stock market is one of the best starts in decades, everybody from Tom Lee to every single analyst on CNBC seems like they are bracing for impact come August and September. Even Tom Lee, who is the most bullish person I've ever seen in my entire life, who said Bitcoin was going to be 1 million by Christmas of 2021, or that the S&P 500 will be 5,000 by the end of 2022, even that guy says that we should brace for an August stock market slump. And even now we're seeing headline after headline talk about the bear market and the recession once again after a 7-month party in the stock market. So historically, what has happened at this juncture? Where are we likely to be headed for August and September, considering the start of the year that we just had? Is there any merit to this? Especially since if you look at the S&P 500 and the NASDAQ, we are so close to all-time highs. We're about 5% away. So is it likely that we will pull back now? Well, I put out a detailed analysis in the Academy this morning showing you how it is very routine for the stock market to see a pullback before hitting all-time highs once again. This happened in 2015, 2018. This happened in 2020. This happened in 2021, where we fall just shy of the all-time highs, see a pullback before continuing higher. We will also get into the S&P 500 and NASDAQ's performance for August and September historically. If you recall, on this channel, I told you that July was likely going to be a green month because the NASDAQ saw 16 green months in a row, 16 green July months in a row, going back 16 years. And then, as usual, I'm going to be diving into some of the plays and how I'm going to be playing this. Let's get right into it. So, as I said before, the S&P 500 is about 5 to 6% away from all-time highs. Why is it that Tom Lee and a bunch of other stock market analysts seem to be extremely bearish at the moment? Well, for one, we are very close to the end of Q2 earnings. We have Amazon and Apple on Thursday, what is this, August 3rd, I think. We have AMD on August 1st, and then you have some of the mid-cap companies like Starbucks, Uber, Pinterest, PayPal, Shopify, Qualcomm. Qualcomm I would consider a mega cap. Either way, a lot of companies reporting this week, but all eyes are going to be on the biggest company in the world, Apple, because it has the chance to actually sway the market one way or another. Another reason is obvious. We haven't seen many pullbacks. If you look at stocks like Nvidia, for instance, really since January 2023, since the beginning of this year, it hasn't seen any major pullbacks, going from 140 all the way to $460 plus. Tesla has gone up from 101 to about 270. This is one of our biggest plays lately. I will get into that. And then you have companies like Meta, like Palantir, that have just gone up 200, 300% year to date. Meta was actually $90 towards the end of last year, and it is now at $318. So because of that, because of the fact that earnings are almost over, because of the fact that the yield curve is worsening once again, because of the fact that the Fed is hiking rates. Last week, they hiked another 25 basis points, absolutely rocketing short-term yields. And if you look at the yield curve again, it is back to being the worst that it ever has between the 10-year and the 2-year. And then historically, if we take a look at the SPY August performance, it is a mixed bag. And if you take a look at the September performance of the SPY, it is one of the worst months if you isolate just month by month on the SPY. Same thing goes for the NASDAQ. In terms of August, it's a mixed bag. In terms of September, it looks like one of the worst months. Let's take a look at a few more stats. Since 1950, the average stock market return for the month of August has been just 0.01%. During the period, the win ratio is about 50-50, only at 55%. When stocks fall in August, the average drawdown is 3.2%. That would imply roughly 150 points downside for the S&P 500. Now, here's the rub that seems counterintuitive. If the S&P 500 has gained more than 15% through the end of July, which it has, this is one of the best 7 months in decades, the average return is actually worse. It falls to 1.4%. The S&P's win ratio declines to 40%, and the average drawdown swells to 3.5%. So there is reason to believe why August and September will likely be pullback months for the S&P 500. Also, I've shared this before, but when stocks go from bear to bull, it is very rare that they go back to a bear market. As a matter of fact, since 1933, it has only happened one time, and that was in 2001, where the stock market went from bear market to official bull market back to a bear market a year later. It's only happened one time. That was in 2001, since 1933. However, typically in the first month after a market goes from bear to bull, we tend to see a pullback. We have not seen that yet. And it's usually a pullback between 5 and 10%, which would be very healthy and very normal, nothing to be scared about. So, with that said, if you are going to hedge, now is the time to hedge. Another reason is because hedges are actually historically cheap, the cheapest since 2008, since this has been recorded by Bloomberg. Now, cheap meaning that the premiums are cheap because the implied volatility is low, and we are at a point of historic euphoria. So when there's euphoria, not a lot of people are thinking of hedges. So just like when the put call ratio is astronomically high, then the market is likely to rally because too many people have poured into puts. Same thing in this situation when everybody's bullish and everyone has been bullish really since the beginning of the year, then really nobody's paying attention to hedges. So if you are going to hedge, especially on S&P 500 options, you are buying options or option hedges at the lowest value since at least 2008. Now, in terms of how we're playing this, we already started selling calls against our shares. We sold calls against Tesla after earnings, up 90% in one day overnight. We sold calls on Meta as well. Those are up now around 20%, but I'm going to continue holding that because I don't care if my Meta shares get called away at $336. So it's a win-win. Either my shares get sold for $336 on Meta, or I get to keep $640 per contract for free if Meta expires under 330 by next month. And as I said before, because it's so rare to go from a bear to a bull to a bear market, I'm going to be buying the pullbacks, especially if we get a 10% pullback or more in the S&P 500, 5 to 10%. I will be buying those up in dollar cost averaging. If Tesla, as I said before, if Tesla sees a pullback, which it already did after earnings, drop 10%, then those are periods in which I want to dollar cost average. I will also be selling puts, cash secured puts, when these stocks hit major support levels. So for instance, if Tesla fills this gap here eventually between 240 and 235, I will likely sell a put for a chance to get it cheaper or to keep the cash, as well as buying shares on top of that. There are different strategies to utilize in a bull market versus a bear market. In a bull market, I'm not worried about falling knives, so I don't mind getting assigned shares at major support levels, especially on stocks that I want to own. And me personally, I only sell puts against blue chip stocks. And then later in the year, I'm definitely still looking at the 2-year treasury. You guys know this is my trade right here. I'm going to wait for the Fed to officially signal that they are going to pause, and then I will likely buy heavily into the 2-year futures and create one of the best opportunities in bonds and treasuries of a lifetime. I'm not buying the treasury itself, I'm buying the futures, which is a much more leveraged product. So, and in the academy, I've also shown people how to put your money in a money market account that gains 5% and still use that money to sell cash secure puts. So you are making 5% on your money the same way as if it was in a CD or money market fund, or as if you bought a treasury, but you were also using that money as collateral for cash secured puts as well. So you are not just letting your money sit there and rot at 5%. You are actually putting it to use for the chance at investing in blue chips at a much lower cost. As I said, I will be doing a video specifically on covered calls and cash secure puts. You guys have requested that. But if you want access to the academy, make sure that you click the link in the description and apply to be in the academy. You get access to my fully detailed analysis, like the one that I put out today, how to hedge, what I'm expecting, etc. You get access to our day trades for options and futures. You get access to the sectors and the stocks that I'm buying long term as well. Plus, you get to chat 24 hours a day with thousands of traders. You get to bounce ideas off of each other, strategies off of each other. It is really a second to none value, as well as the Zoom calls with me, if that wasn't enough. We get into the mastermind Zoom calls every single month, going over how to trade, how to chart, how to trade derivatives such as futures and options, how to pick your strike prices, how to pick your expiration dates. It's really a jam-packed academy. So make sure that you click the link below and sign up. Let me know in the comment section what you think. Do you think that August and September are going to be bearish months or not? Not necessarily a bear market, but drawdown months. Are you going to be hedging? Are you looking to put some money to work on these pullbacks if we get them? Let me know what you think. Anyway, I do think we are going to hit all-time highs by the end of the year, unless we have some sort of black swan credit event, which neither you or I can predict. Let me know in the comment section below. Subscribe to the channel, hit that notification bell, hit that thumbs up if you got anything out of this video. Stay safe out there, traders. Peace.